But thanks for everyone being here at our first Path Forward webinar, something new we're launching this year that we're going to be doing every quarter, where myself and Justin, our Chief Investment Officer, walk through kind of what was and what we're paying attention to. We're really honored that you're with us and we get the opportunity to do this. We will be doing Q&A at the end. There's a button at the bottom of your screen, Q&A. If you click that, and I'm told, never done it, if you click that and type in your question, it'll come directly to us. But anyways, we're going to go ahead and get started. So first, we're going to talk about the big picture. The big picture is the U.S. economy has been very strong, relatively speaking, to the rest of the world. Justin prepared this slide comparing it to the other major economies. Justin, what stands out to you?
Well, first off, again, thank you for joining us today. This is actually pretty important. Basically, this is looking at all the major economies of the world, and it's taking GDP growth, so economic growth, and it's basically subtracting that from inflation, so real economic growth. And as you can see, all countries have slowed a bit recently, but for the vast majority of last year, the US was significantly strong, especially as compared to Europe, the Eurozone in particular, the United Kingdom, Japan, and China. So compared to all the other major economic regions, a lot of US real economic strength. That was, we think, probably the defining theme globally last year.
Yeah, outside of Taiwan, they all kind of look the same, and then you see Brazil kind of picking up here at the later ends. But yeah, the U.S. dominated last year, and again, as Justin said, until recently, the U.S. economy was pretty strong, but it's slowed a bit, as this shows here through a snapshot of various different data points.
Yeah, we would define the U.S. economy as firm, but slowing a bit on the margin. So if you were to unpack that just by some very high-level indicators, you've seen unemployment stay pretty much stable, although jobless claims have started to pick up here in the recent months. And there continues to be not very much turnover in the labor market. So you're not seeing people that are unemployed looking for new jobs, but at the same time, you're not seeing a whole lot of offerings for new jobs as well. So this is something that'll be really important to keep an eye on going forward. The question being, will the economy slow further based on the fact that interest rates are historically high, which we'll touch on here a bit later, or will the economy reaccelerate? That will be the dominant question for 2025.
Yeah, and just last week we saw the unemployment rate actually tick lower. Jobless claims go down, jobs created, and we saw initial hires go up, which is what kind of rocked the markets last week. So again, we're paying close attention to this, but the folks that are calling for, we call them the chicken littles, calling for the sky falling because of the labor market. We feel like they're missing the forest for the trees there. Another interesting component that we're watching is, what's been a driver of the United States strength, and a lot of that has come from the government sector.
Yeah, and this chart goes back to 2018. So the bottom portion of the graphic is real government consumption and investment. And as you can see, it jumped up pretty dramatically up until recently, and then it, obviously stalled out due to relatively high comparisons. But to Ryan's point, this has been a big driver. And not only has this been a big driver in absolute terms, it's been a very big driver in terms of real terms. So even if you account for inflation, government spending has been pretty significant. And there were several programs announced during the previous administration that have yet to see their full impact in terms of what that does to the economy. Adding to government spending, there's another key part, which is the top graphic, real disposable personal income. And unlike government spending, that has actually been slowing down for some time. So think of that as a function of not only is there kind of a slowing relative growth in terms of income to the population, but inflation has somewhat stabilized at a higher level relative to pre-pandemic. So that's something that has weighed on real disposable personal income, and it's going to have to be something that also we keep a very close eye on because the consumer is the dominant driver of the economy.
All right, and next one, looking at inflation, obviously it's been on our minds and in our news feeds for several years. It has come down substantially, but from a historical standpoint, it remains a little bit higher than market participants would like.
Yeah, and what really stands out in this graphic is just the giant surge in this indicator immediately post pandemic. And although that has slowed pretty substantially, the current levels are very much above what they were for roughly 10 years prior to the pandemic. So, the economy, the markets, pretty much everyone got used to what was a very low inflation reality. And although that could revert and become the case once again, the critical moment right now in any overall view of the economy is the fact that inflation has so far stuck to higher levels.
Yeah, what he was referencing was this time frame. I mean, you're talking almost 12 years of really low inflation. So when it skyrocketed like it did, it really caused some reassessment by financial leaders as well as corporate people running corporations and also the consumer.
Yeah,
Anybody that's went to the grocery store understands that food inflation is sticky. Here's another way to look at inflation, and you see a lot of these numbers thrown around: core PCE, core CPI, super core, and then also we have hourly earnings in here. It's just a different view on where is inflation really sticky and where is it coming from.
yeah, and what's interesting here to tie this into the previous graphic is the hourly earnings component. So even though hourly earnings has maintained pretty significant strength relative to, again, the pre-pandemic period, because the fact that inflation has also stayed high. Back to the prior slide, real disposable income has actually started to decline. And I think the big question here, according to our analysis, is what they call super core. So this is basically eliminating, a lot of the food inputs. It's eliminating energy, and the big dominant piece of that is actually housing and the so-called cost of shelter. So because there is a lag in terms of rents readjusting and just how that gets measured, there is a possibility that this will start to come down in the months ahead. But at the same time, if there starts to be a big uptick in demand throughout the economy, if the economy does reaccelerate, this could be a component that could actually stay high for some time. So we're on the precipice of really being able to determine, is this a new reality in terms of inflation relative to the prior decade plus, or are we going to revert back to much lower levels that you see on this chart?
Another component from a big picture standpoint is just the outpacing of U.S. interest rates relative to the rest of the world, which you can see here on this chart.
Yeah, and this is what we think is probably the biggest potential disconnect in global markets right now is the fact that U.S. markets are pricing in historically or modern history high interest rates, and much of the rest of the world, in particular the other major economic regions, are seeing their interest rates drop back down substantially. So Europe, there's been a big slowdown in Germany, but in particular China. China is seeing its interest rates absolutely collapse, which, although is possible that it could maintain, it's not necessarily a sure thing to think that the two largest economies are going to see their interest rates diverge that significantly for that long due to just the interconnected nature of that. So this is a disconnect that we not only are going to continue to watch, but we think has some possible opportunities connected to it.
Yeah, and we've been writing about it. There's not anything to take action on per se now, but it bears watching. And part of our interest rates being so much higher, it drives a lot what's going on in this chart here, Justin.
Yeah. So the US dollar index, which is weighted in terms of the major economies. So think of this as the dollar against the euro, the dollar against the pound, and just a wide range of other global currencies. Last year was one of the biggest up years, in fact, the second biggest up year for the dollar index in the past decade. And the reason for that being the summation of the prior chart. So US economic growth, higher than much of the rest of the world, real economic growth in particular, and US interest rates notably higher than the rest of the world. And those two things combined have created strength in the currency, which has been net positive, at least for flows into the US, capital flows into the US. But going forward, if this continues, this not only hurts the US chances of reviving exports in terms of being competitive, but it also puts a lot of pressure on many other parts of the world as they end up needing to buy things and service debt in dollars and then generate their income in their local currency. So we think this is a very important graphic to keep in mind.
And from a sentiment standpoint, what's really interesting is about 4 years ago, the demise of the dollar, picked up. We talked to a lot of advisors as well as their end clients that we serve, and that rhetoric just picked up. And what you see is one of the best 4 year periods for the U.S. dollar growth over in the last 4 years. With 3 of those years, it's up 5% or more per year. So back to know the data and be very careful about what you're listening to. um, and then let's talk about global trade. That's on everybody's minds right now, as this chart talks about.
Tariffs, tariffs, tariffs. So this is Oxford Economics did a survey of various different types of individuals. In particular, individuals who are involved in some sort of investment in one form or another. And it basically asks, what is the biggest worry over the next 2 years? And no surprise, a global trade war, so called, dominates this significantly more than the Russia NATO situation, notably more than conflict in the Middle East, more so than China, Taiwan. And what's really interesting is if you go back, a decade or so, it would have been the Eurozone crisis that kind of dominated people's minds in terms of risk. And now that is barely even visible in terms of kind of what people are worried about. So all eyes on what happens with global trade with the new administration here in the U.S.
Well, and this is an interesting chart. They've done it for they used to do it for AI recently, and then they did it for inflation before that. They did it for COVID before that. But this is just an interesting summary of how many companies are discussing tariffs on their conference calls, their earnings calls. And as you see here, really picked up November and December.
Yeah, I mean, it absolutely spiked. And, as a result of this, a lot of these companies that have mentioned tariffs and earnings calls have naturally moved to take action before the new administration in terms of managing risk. So there's been a lot of, front ordering of inventory and things of that nature. And corporate America has very much been attempting to, as best they can, not only risk assess, but take action to risk manage a wide variety of potential outcomes as far as tariffs could that could come into play.
And last thing on tariffs is, everybody's talking about them. It's good as an American, it's American pride, but what does it do as investors? What are some of the possible outcomes? This is a great study from the Peterson Institute on what's the actual possible outcomes to various major countries if tariffs are uh, increased and laid on different countries.
We think this is very important, not because any institute, in this case, it's the Peterson Institute of International Economics, but not to say that anyone is able to really model this out with extreme accuracy. But what this graphic does show is the varying impact across global economies that different types of tariff implementations would actually have. So the chart on the left is assuming a 10% additional tariff on all US trading partners. And as you can see, that disproportionately hurts Mexico, Canada, and Japan. Versus the chart on the right is assuming a 60% tariff on China being the dominant initial tariff implementation. And as that shows, obviously that has a much larger negative impact on China. But interestingly, also, according to this analysis, that would have a pretty significant impact on the United States as well, as would both scenarios.
Yeah, and that's one of the often forgot about aspects of tariffs is there is a period of time that it negatively impacts the United States. And until supply chains are worked off, et cetera, you really see that here, where the United States goes down and then bounces right back up. So again, keep in mind that not all things are are positive, although they may be good for the United States long term. Now we're going to move into domestic equities, talk about a few charts, few interesting things. Also fixed income, international equities, and some commodities. As a reminder, there's a Q&A button at the bottom of your screen. If you click that, type in your question. That will come directly to us, and we will answer those at the end. So let's dive in. Domestic equities. It's a pretty good couple years, Justin.
Back-to-back gains of 20% plus, which, as you can see here, this chart goes back to 1930, and each blue bar represents the number of consecutive years of 20% plus gains in the S&P 500. So it's, to say the least, a rare occurrence. It did happen for a few years consecutively during the late 90s into what was ultimately the dot-com bubble. But the last 2 years, this is the first time we've seen back-to-back 20+% advance in the S&P 500 in well over a decade, over 2 decades, in fact.
And Ryan gets in the business right here. I didn't necessarily pick the best time to enter the profession. And Justin and I talk often about how we hate giving forecasts for entire years. And this is probably one of my favorite pieces of data chart in this entire deck is this shows, Wall Street strategists were way off last year.
Yeah, there's at first glance, there's kind of a lot to unpack on this graphic, but very simply, if you look at the x-axis there at the bottom, that's the level of the S&P 500. And then if you look there on the y-axis, that's all the different investment banks and well-recognized strategy firms. And basically, the black dot is where they predicted the S&P to be at the end of 2023. And then the yellow dot at the very bottom is where the S&P 500 actually ended the year of 2024. And the pink colored dot there is at the very end of last year. Each and every one of these organizations immediately said, oops, and revised their forecast upward after the advance in the stock market had already happened. So one thing we continue to sort of reiterate is these long range forecasts in terms of what the market will do over a period of time is basically almost always a response to what it has already recently done. And not to say that that is something that's categorically terrible to do, but we would tend to say ignore almost all of these forecasts, regardless of the institution that's putting it out. And that is very visible in this data.
Yeah. And we've talked about this at length, but this is a great visual that where the returns have come from the last couple of years have been pretty concentrated.
Yeah, so since the bottom of the market in October of 2022, 59% roughly, obviously this changes week to week, of the gains in the S&P 500 have come from the top 10 stocks, which is pretty significant when you consider just how concentrated that has been. But we've been in a market reality for quite a few years now where the biggest of big companies just keep getting bigger and continue to outperform pretty much everything else. And, there's several reasons for why that is, but those reasons seem to be pretty durable. And this just continues to show up pretty much year after year.
Yeah, and I mean, what does this look like for us again? And from my vantage point, talking to so many different financial advisors and their end clients, is what we're seeing is clients are moving away from wanting diversified portfolios because a diversified portfolio underperforms being concentrated when so much of the returns have been concentrated in a few companies. And we've also seen, people that are a little more on the conservative side want to get more aggressive. Which again, this tends to happen when the markets have been good for a while, but as we know, markets don't stay in one particular trend or direction. This just real quickly shows the Nasdaq's performance relative to smaller companies represented by the Russell 2000.
Yeah, so if you go back, roughly 20 years now, this chart basically shows that if the chart goes up, the NASDAQ 100, which is the biggest companies mentioned before, outperforming the Russell 2000, which is a gauge of, publicly traded small cap companies. So what we find really fascinating about this chart, and we put a little yellow line there, that was during the pandemic. So during the pandemic, these big companies that are very much involved in technology, et cetera, in our daily lives dramatically outperform small cap stocks. And, many people rush to say that, okay, this is the top in this dynamic, and going forward, smaller companies should outperform. And although that did happen for a brief period of time, we've since seen this dominant trend continue. So the conclusion from this is we are not going to make any bold calls that there is significant value in smaller companies and that lots of exposure should be rotated from the big companies to the smaller ones, because we think there are some very long running and durable reasons why the biggest of big companies continue to outperform, and that's very visible in this graphic.
Yeah, just looking at history and saying, well, this ratio is really high. At any one of these points back in time, you could have said this ratio is really high. We need to buy small caps. And you would have been wrong because you're looking at one data point in isolation. That doesn't necessarily always work as we saw. Moving on to interest rates. Right here, we've got the expectations for what the Federal Reserve is going to do, laid out over two time frames.
The big dominant theme in fixed income and really markets in general over the past 2 to 3 months has been the market expected there to be several rate cuts in 2025. And now the market is expecting there to be less than one 25 basis point rate cut throughout the entire duration of 2025. So this is very much a response to the fact that inflation has stabilized at higher levels and US economic growth has been relatively stable. And the orange line here is simply what the market did expect in terms of the federal funds rate to be. And the green line is, as we got into the end of last year, what the market is currently expecting.
Yeah,
So,
pricing in less rate cuts, and that's also why we've seen recently good news being bad news. For instance, on the labor market, right? The stronger the labor market, the less likely the Federal Reserve is to cut interest rates. And you saw lots of market participants were off sides on that and reacted quickly. And you saw interest rates drive higher, and stocks sold off at the end of last week pretty violently. And that's the old good news is bad news from an investor standpoint. This again talks about Fed funds rate in 92 to 98 relative to now, which is, history doesn't always repeat itself, but sometimes it rhymes, and that's the point here, I believe, Justin.
Yeah, and the reason we thought this would be interesting to share is that the post global financial crisis period was, and really throughout much of modern history, has been very much dominated by the Fed will hike rates as much as they can and then be very quick to cut rates all the way back down to where they started. And that has been pretty much what happens the majority of the time. However, as you can see here, from 1992 to 1998, there was actually a rate hike cycle that was fairly sharp. There were, in this case, three cuts, and then the Fed didn't do anything for a year, and then ultimately ended up hiking rates again before ultimately starting to then cut rates again. So the reason we bring this up is it's always important to keep an open mind and realize that just because the Fed started cutting rates doesn't mean they have to actually continue to do that aggressively. In fact, they might actually pause, or who knows, even they might actually start to raise rates again, and that will certainly have a major impact across all markets, in particular the stock market. We do believe.
Yeah, and rates going up haven't been kind to holders of U.S. Treasury bonds.
Yeah. So this basically shows that Treasury notes, so think of US government debt inside of 1 year to maturity, that debt has outperformed the Treasury market of longer duration for now what is a fourth straight year, which is the longest streak going back all the way to 1992. So it doesn't get as much attention as the stock market, but there have been some extremely significant and historically rare things that have happened in global interest rates and in particular the US Treasury bond market, which as we see here, and this could lead to what we think to be some pretty notable opportunities.
Yeah, and that's, going back in time, right? That's been one of our key holdings has been short-term U.S. Treasuries for clients that it's appropriate for is owning for their fixed income portion owning the highest credit quality and short maturities. That has benefited our clients tremendously over the last several years. Um, and then everybody talked about the inversion. It was a long historic inversion where the short-term, shorter maturity bonds were yielding more than longer ones. And that's ended.
Yeah. So if you take this chart, this line is simply taking the 10-year Treasury yield minus the 2-year Treasury yield. And as you can see to the far right side, that was negative for a few years here recently, which was a historic stretch, but has now started to use the term, the yield curve has started to steepen. So there's obviously two ways that this dynamic can steepen out. One way could be that rates go lower on the short end, which would be the Fed cutting interest rates. And another way could be that rates are actually going up on the long end relative to the short end. And recently we've seen the latter.
Yeah, and also just real quick in the red, those are the start and ends of recession. This has been many folks a recession indicator for them is when the curve reinverts, can be the signal of some economic pain. We shall see whether that's the case this time or not. Thus far, it is not. Moving to equities outside of the United States, basically similar to NASDAQ versus small caps domestically, U.S. stocks have dominated relative to the rest of the world for a long period of time.
Yeah, this chart's very simple. So this is just S&P 500 relative to a market cap weighted index of non-US stocks. And as you can see, for many, many years now, US stocks, US large cap stocks in particular, have outperformed.
Yeah, and it's even worse for emerging markets. Think of China, Brazil, Taiwan, the what are considered emerging equity markets and around the world. They've not had a good decade plus.
No, underperformed the US stock market substantially, in many instances, well over 10% underperformance in every year of the past 10 plus, except for one. So we continue to emphasize that a lot of these markets are good for opportunistic trades, but very bad for long-term investments.
And last but not least, we'll touch on some commodities. We spent a lot of time talking about the dollar, as well as interest rates and inflation. And here we see oil starting to jump here recently.
Yeah, this big spike in oil that peaked back in 2022. Since 2022, as you can see here, the price of oil dropped pretty notably and then basically moved sideways for a couple years. And that obviously has been a tailwind to the economy and to the consumer. So we're seeing oil start to perk back up here recently, and that's something that we'll need to watch because historically, higher oil prices are positively correlated to higher interest rates and are oftentimes a leading indicator of an economic slowdown.
Yeah, and if oil continues to go higher, it's back to the personal spending, but also inflation, right? If oil moves higher or even settles in the mid 80s, that puts pressure on the consumer, which is important to obviously economic growth, and it also lights a little fire in inflation. Um, and then another interesting chart, gold's been pretty good for a couple years, but the gold ETFs, the big index funds that hold gold, they've seen some outflows. What do you think about that, Justin?
Yeah, we find this to be very interesting. So gold had a big up year last year for a few reasons that would be a more of a long form conversation. But ultimately, since 2021, we've seen money come out of gold ETFs, which just means that U.S. investors, retail investors, and professional investors have actually not been buying gold. And this is very different relative to the 2016 2020 period when gold was strong for a few of those years, where tons of money went in through ETFs. So we basically kind of deduce this to say that the recent strong performance of gold has been driven by global money that has not been U.S. traditional investment style portfolios.
Yeah, and that wraps up for the data, but I know, Justin, we wanted to spend some time talking a little bit about two of our more active strategies that we run here that are just available in Sollinda. Global thematic trend is, we had for years people would say, "Hey, what's your best ideas, your best ideas strategy?" And so, we created this based on our data, price signal, and momentum and trend analysis. We're going to look for assets that are starting a new trend, whether that's up or down. And Justin, if you want to talk a little bit about GTT over the last year.
Yeah, so this is a strategy to Ryan's point that we've been, working on in some form or fashion for quite a few years now, and have been running this for just over a year here at Sollinda Capital Management. And think of global thematic trend as equity market, stock market like volatility. So we're obviously targeting returns that are in line with what one would get in the stock market over time. But we're looking to do that with a degree of correlation that is not super strong to the market. So trying to be able to provide some solid returns, stock market like volatility, but be able to do it in a way that is our attempt is to be more diversified than what you would get in just investing in the stock market.
Yeah, and then the counter to that is the active risk focus equity. That's our low volatility attempt to produce some returns that are above inflation and also more than the bond market, but with extremely low volatility.
Yep. So think of the active risk focused equity as a stable, low volatility portion of the portfolio. And our effort there is to create returns that are higher than what you would get in the aggregate bond market or in the risk free rate, but to do it with volatility that is less than what one would receive in the stock market. So we're finding that, not only do these strategies offer an interesting market exposure in their own right, they often are used pretty nicely together as well.
Yeah, and if you'd like to have a deeper dive on either of those, talk to your advisor, and we're always available to chat with them as well. And so now it's time for Q&A, and I actually have two questions. One was um, the Fed has lowered interest rates. Why are interest rates going higher? And I thought that was a fabulous question. Justin,
Yeah,
you
that's a
wanna
good
attack
one.
that?
It might actually be the most important question. And when it comes to these things, we never can know for certain what's moving a market, but we can, use a variety of tools and history to sort of suggest what we think is likely moving markets. And in this instance, what you're seeing in our belief is that as the Fed has stopped lowering interest rates, well, first they lowered and now they have paused. That is basically signaling to the market that the prospect of higher for longer inflation is going up. And at the same time, there are, pretty significant worries growing about fiscal spending or debt in the US. So you combine the two of those things, the outlook for higher inflation long term and the prospect of more supply of long term government debt, and the market has repriced longer duration interest rates pretty substantially higher very quickly.
Yeah, and what I would say and what I usually say is the Federal Reserve controls the short maturities, call it 2 years and less. And the longer maturities, where we've seen the most increase in rates since the Fed started lowering rates, is driven by the market's anticipation of future interest rate or future inflation and economic growth. And to Justin's point, if market participants are anticipating interest rate or inflation staying higher for longer than originally expected, you're going to see interest rates go higher or stay higher, which again, higher interest rates puts pressure on the consumer, puts pressure on companies, puts pressure on the housing market. So it's not that the big move hurts. It's the longer they stay, the more it kind of erodes the access to credit and the ability to have free cash flow to spend elsewhere. Um, and oh, that was the only question. But that's it. We really appreciate you guys spending some time here. We're going to be doing this every quarter to walk through what's happened and what we anticipate moving forward. We're also doing a video series twice a month, every couple of weeks. Chart overload. Justin says it's not chart overload, but I say it's chart overload. Where we just talk through what's the most recent items that are grabbing our attention, and also we talk through what some of the major news outlets are maybe running with. Again, just to be transparent and accessible, to try and explain what's going on from our perspective, and then also what we're doing about it. We always want our commentary to match what's going on in portfolios. We never want there to be a mismatch, but we appreciate every one of you joining us, and we'll be back next quarter. We hope everyone has a great week.
Thank you.